a 10% yield, monthly income and exposure to the Nasdaq 100. Usually that comes with a big trade-off, but this new ETF might have found a way around it. Welcome back everyone, I'm the Swedish dividend investor. So, as the title suggests, we are going to take a look at a brand new ETF, this time from Invesco. Invesco Nasdaq 100 Income Advantage UCITS ETF, ticker QQIA. If you want to know how covered calls work, I have linked a video in the description where I go through everything you have to know. As always, this is not financial advice. I'm just sharing my investing journey, my experiences and my analysis. Read the full disclaimer in the description. You might think, what's the point when we have an ETF such as Global X Nasdaq 100 Covered Call ETF, QYLE? Well, let's talk a bit about QYLE's option strategy. First off, they sell call options on 100% of the portfolio, which severely limits the upside. But they also sell at the money options, meaning around the same strike price 30 days forward as it is trading at the time of the writing of the option, which does pay more in premiums but also limits the upside. Now, if we trade sideways, that's not an issue. But if we get a steep downturn followed by a quick recovery, QYLE will lag behind massively. They also have a passive strategy, which is not flexible. We can just look at a longer term chart for the share price for the US version, QYLD, which is the same as the UCITS one. We see a massive drop from time to time, and they never recover. Sure, we get a pretty hefty yield of about 11 to 12%, but the strategy is pretty outdated and the long-term performance is hurting. So, what is QQIA? It is new in Europe, but they launched both an American and a Canadian version in 2024 with the same name, and the ticker is QQA. For reference, we will use the American QQA to check performance and dividends later. Checking Invesco's homepage, their total expense ratio is quite low for being actively managed, only 0.29%. The asset under management is around 6 million. Remember, this is a new ETF. The American version have a yield of 9 to 10%, so we could expect a somewhat similar yield on the UCITS version. The Invesco Nasdaq 100 Income Advantage UCITS ETF aims to generate income and provide equity market upside participation through passive exposure to the Nasdaq 100 index, while also providing some downside protection relative to the benchmark in the event of broad equity market downturns. The fund distributes dividends on a monthly basis. The fund aims to achieve its investment objective by physically investing between 70 and 85% of the portfolio in the securities that compromise the benchmark. The remainder of the portfolio will be held in cash or cash equivalent assets and will also be used to implement covered call and cash secured put strategies. So, they use both a call and a put strategy. Now, selling put options is basically the same as calls, except in the opposite way. When you sell a put, you have the obligation to buy the underlying asset if it falls below the strike price. Real quick example. The asset is trading at $100. Invesco sell a put option with a strike price of $90 and they collect a premium. If the asset is above $90 30 days in the future, it expires worthless. If it falls below $90, Invesco has to buy the shares, regardless if the asset is trading at $89 or $1. Now, they only do this with a small portion of their portfolio and not all the time. It could be smart to use in a bull market, to not sell away all the upside, and vice versa in a bear market. So remember, they are only selling calls and or puts on 15 to 30% of their portfolio. Let's quickly go over their top 10 holdings. We got Nvidia, Apple, Microsoft, Amazon, Tesla, Meta, Alphabet, Walmart, Alphabet Class C, and Broadcom. if we exclude the cash, options and bond positions. The Nasdaq 100 is pretty tech heavy, but it also includes companies like Pepsi, Costco, Amgen and Honeywell, to name a few. So it's not 100% tech. 38.28% to be exact according to Invesco site. So let's check the American version, the total return performance, how it has been doing against the S&P, Nasdaq 100 and most importantly QYLD. This goes back to their inception on the 16th of July 2024 and the closing of yesterday. So that's the 23rd of March. So first off, the performance since inception, 4.27% for QQA. That might seem underwhelming, but let's compare it to S&P 500, Nasdaq 100 and QYLD. The price return of S&P in light blue is 16.12%, Nasdaq 100 in purple 18.47% and QYLD at negative 4.28%. Now that's only price returns, so let's check the total returns. QQA 23.22%, S&P 18.69%, Nasdaq 19.58% and QYLD at 19.03%. Well, not only does it beat the S&P 500, but also the Nasdaq 100. I would say this is due to the recent pullback, but still, that is quite impressive. QYLD actually did pretty good here, but we can see it lagging just until recently. Checking their dividends, we can see they go up and down a bit, but I would say it is in a pretty good range. A low point of around $0.38 to a high point of $0.46, but usually around 0.4 to 0.44. So to summarize, we could expect to get around a 10% yield with positive performance, monthly payments and exposure to the Nasdaq 100. I originally made the script for this video almost a month back, but I didn't have time to record it. Since then, the QQIA, the UCITS version, has actually paid their first distribution, $0.1629 US. That's 0.14 euros. Annualized, if they keep it up, that's 1.68 euros. And as I'm recording, the price is about 16.28 euros, giving us a yield of 10.3%. Sweet. Now, there is always the currency risk, but if you have watched my videos before, I think of the currencies as the market. It goes up and down, and if we invest along the way, we get an okay average price. I don't think investors would complain when they bought dollar assets low and then the dollar goes up. I sure didn't during 2022, but buying back then felt expensive. I'm glad the covered call space in Europe is growing. The only big index with a good strategy we lack are the S&P 500. Let's hope Invesco makes a UCITS version of their RSPA, Invesco S&P 500 Equal Weight Income Advantage ETF, with their 9 to 10% yield and a pretty decent total return of 16.26% versus S&P's 18.24%. Time will tell, I guess. Anyway, let me know what you guys think about this one. Are you considering it? Is it better than QYLE? Let me know in the comment section down below. And if you enjoyed this, don't forget to like, comment and subscribe. It really helps the channel. Thanks. But that's it for today. I will see you guys in the next one. Until then, stay smart, stay patient and keep stacking those dividends. Ha det gött!